So this is a trade we're in. This is a long vertical spread in the URI, United Rentals. We've been in this trade for 7 days. Stock has moved about a 1 standard deviation to the upside. We are in a 310, 320 call vertical that is now in the money. The trade is currently showing about a 15% return on risk. One thing I continue to talk about is finding ways to reduce risk, leaving room for more upside, and potentially trading around the position because we do have 51 days until expiration. So this is an adjustment that I am considering here. Looking at a chart of United Rentals, we are now trading between 1 and 2 ATRs away from a rising 21 EMA. This is not bearish by any means, but odds are we are likely to see some sort of reversion, or maybe we're going to pause and consolidate before potentially resuming a move to the upside. So right now we are in 310, 320. First thing I want to do is look at what at-the-money options are pricing in for the next 51 days. Looking at the price of an at-the-money straddle, we see that an expected move is about plus minus 45, maybe 47. I'm going to go out and look for an option around delta 25. Right, so 370 is a 25 delta call. I'm going to sell a 10 wide call spread, right? It's going to be 10 points wide, just like our long vertical spread, right? We are in a 10 wide call vertical spread that we're long. I'm going to sell a 10 wide call vertical spread against it, converting this position into a call condor. So selling a 370, buying a 380. Right now, what I see is that this spread is going for about $2.15. I think that selling it for $2 is a decent trade here. This is going to reduce our delta from about +7 to about +2. So a further move to the upside is not going to benefit us as much because we are giving up our long delta on the upside. However, on the downside, instead of losing $7 for every 1 point move, we're only going to lose about $2 per 1 point move. At the same time, we are going to reduce the cost in this trade from $4.70 down to about $2.70, right? So we're giving up some of the upside in exchange for less of a risk to the downside. We are also introducing risk to the upside, which means that if the stock shoots past 380 inside of the next week, we're going to have a potential adjustment to consider on the upside. Best case scenario here is that the stock trades somewhere between 320 and 370 for the next couple of weeks. We have our long vertical spread that's going to appreciate in value. At the same time, we have to assume that over the next couple of weeks, the 370, 380 is going to decay. It's going to lose some of its value. So we could potentially make money in both spreads. So this is what the adjusted trade will look like, right? So we have best case scenario where between 320 and 370. If we start to move outside of the break evens, we shall consider another potential adjustment.